Systematic withdrawal. Plans versus annuity. Income. One of the most fundamental decisions you'll make in retirement is how to convert your savings into income. Two dominant approaches compete for your attention. Systematic withdrawal plans, where you draw down your investment portfolio at a sustainable rate, and annuity income, where you exchange a lump sum for guaranteed monthly payments. Each approach has passionate advocates and genuine strengths. Today I'm going to give you an honest comparison so you can decide which strategy or which combination of both is right for your retirement. Let me start with systematic withdrawal plans, which is the approach most financial planners recommend. Under this strategy, you invest your retirement savings in a diversified portfolio and withdraw a fixed or variable percentage each year. The classic version is the 4% rule. Withdraw 4% of your initial portfolio value in the first year and adjust that dollar amount for inflation each year. On a $1 million portfolio, you'd withdraw $40,000 in year one, then $41,200 in year two, assuming 3% inflation, and so on. The advantages of systematic withdrawals are significant. First, you maintain complete control of your money. Your assets remain yours, invested in your accounts, and you can adjust your spending up or down based on circumstances. If you need $20,000 for a home repair, you can take it. If the market crashes, you can temporarily reduce withdrawals. This flexibility is the single greatest advantage of the systematic approach. Second, your portfolio has growth potential. Because you remain invested in stocks and bonds, your portfolio can grow over time, potentially leaving you with more money decades into retirement than you started with. Historical studies show that in most scenarios, a retiree using the 4% rule with a balanced portfolio would have ended a 30-year retirement with more money than they began. Third, you leave a legacy. Whatever remains in your portfolio at your death passes to your heirs. With an annuity, when you die, the payments typically stop and nothing passes to your estate unless you purchased a specific rider. Fourth, you maintain liquidity. If priorities change, if you want to move, help a family member, or handle a medical emergency, your money is accessible. Now let me explain the annuity approach. A single premium immediate annuity is the purest form. You give an insurance company a lump sum and they pay you a guaranteed monthly income for life. A 65-year-old man investing $500,000 in a SPA might receive approximately $2,800 per month for life, regardless of how long he lives or what markets do. A 65-year-old woman might receive slightly less because of longer life expectancy, approximately $2,650 per month. The advantages of annuities are equally compelling. First, guaranteed income regardless of market conditions. During the 2008 financial crisis, retirees with annuities continued receiving their checks while those relying solely on portfolio withdrawals faced gut-wrenching decisions about whether to sell stocks at 50% losses. The psychological security of guaranteed income cannot be overstated. Second, annuities provide longevity insurance. If you live to 100, the insurance company keeps paying. The annuity eliminates the risk of outliving your money, which systematic withdrawals cannot fully guarantee. The actuarial math behind annuities means you effectively pool longevity risk with millions of other policyholders. Third, annuities can provide a higher spending rate for those focused on maximizing lifetime income rather than leaving a legacy. Because annuities use mortality credits, essentially the payments that would have gone to those who die early are redirected to those who live longer, they can provide more income per dollar than a safe portfolio withdrawal rate. Fourth, simplicity. There are no investment decisions, no rebalancing, no worrying about market timing. The check arrives every month. Now let me address the honest disadvantages of each approach. For systematic withdrawals, the risks include sequence of returns risk, where poor market returns early in retirement can permanently impair your portfolio. There's also behavioral risk, the temptation to panic and sell during downturns. And there's the fundamental uncertainty, and no one can guarantee your portfolio will last. For annuities, the disadvantages include loss of principal access. Once you annuitize, that money is gone. You can't withdraw a lump sum for emergencies. There's also inflation risk. Most fixed annuities don't adjust for inflation, meaning your purchasing power declines every year. Annuity fees and insurance company profit margins reduce the efficiency of the product. And if you die early, you may receive far less in total payments than you paid in premium. So which approach is better? The research increasingly points to a combined strategy. Use annuity income to cover your essential expenses, the non-negotiable costs like housing, food, utilities, healthcare, and insurance. Then use systematic withdrawals from your investment portfolio to cover discretionary spending like travel, entertainment, gifts, and hobbies. This combined approach gives you the best of both worlds. The security of guaranteed income covering your needs, plus the flexibility and growth potential of investments covering your wants. Financial planners call this the income floor plus upside approach. Let me put numbers to this strategy. A couple with $1.5 million in retirement savings and $40,000 per year in Social Security might have essential expenses of $60,000 per year. Social Security covers $40,000, leaving a $20,000 gap. They could purchase an annuity for approximately $350,000 that provides $20,000 per year in guaranteed income, covering the gap. The remaining $1.15 million stays invested in a diversified portfolio from which they withdraw 3.5 to 4%, approximately $40,000 to $46,000 per year for discretionary spending. In this scenario, their essential expenses are 100% covered by guaranteed income, Social Security plus annuity, regardless of market conditions. Their discretionary spending is funded by their portfolio, which has growth potential and provides legacy value. If markets crash, they can temporarily reduce discretionary spending without affecting their ability to pay for necessities. There are several types of annuities worth considering. Fixed immediate annuities provide guaranteed payments starting now. Deferred income annuities, purchased now with payments starting at a future date like age 80 or 85, can be very cost-effective for insuring against extreme longevity. Fixed indexed annuities offer returns linked to a market index with downside protection. Variable annuities with guaranteed minimum withdrawal benefits provide both investment growth potential and income guarantees, though they come with higher fees. For retirees considering this combined approach, here are the key factors in determining how much to annuitize. The more your essential expenses exceed your guaranteed income sources, the stronger the case for annuitization. If you have strong longevity in your family, annuities become more valuable because you're likely to collect payments for longer. If you're risk-averse and market volatility keeps you up at night, a larger annuity allocation reduces stress. If leaving a legacy is a high priority, annuitize less and keep more in your investment portfolio. One important consideration, shop annuity rates across multiple insurance companies. Rates can vary by 10 to 15% for identical products. Use an independent annuity marketplace or a fee-only advisor who doesn't earn commissions on annuity sales. And only purchase annuities from highly rated insurance companies, A-rated or above, by AM Best, since your payments depend on the insurer's ability to pay. Here's your action plan. Step 1. Calculate your essential monthly expenses, including housing, food, healthcare, insurance, utilities, and taxes. Step 2. Calculate your guaranteed income from Social Security, pensions, and any existing annuities. Step 3. Identify the gap between essential expenses and guaranteed income. Step 4. If a gap exists, get quotes from at least 3 insurance companies for an annuity that covers the gap. Step 5. Invest remaining savings in a diversified portfolio for discretionary spending and legacy goals. Step 6. Review this balance annually and adjust as your spending needs change over time. The retirement income question isn't systematic withdrawals or annuities. For most retirees, the answer is a thoughtful combination of both, using each strategy where it's strongest, guaranteed income for security and portfolio withdrawals for flexibility and growth.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.